you, James.
Thank you, Linda. Good afternoon, everyone, and welcome to the HRA's webinar series, where today we'll be looking at protecting the interests of owners in the hire industry. Pleased to welcome from HLB Mann Judd, our accounting and business advisory partners, Matthew Hocking and Nicholas Guest, who will be taking us through today's presentation. For everyone that's dialed in, thank you. And if you have any issues, any technical issues, please post those in the chat function and we'll do our best to resolve those. As far as questions go, feel free to type questions into the Q&A function and we'll either address those through the presentation or at the end. There'll be a session at the end for more questions and answers, so we look forward to addressing all the topics that you raised then. Well, it's up to me now to hand over to Matthew Hocking from HLB Mann Judd to start today's webinar. Thank you, Matthew.
Thank you. Good afternoon, everyone. Thank you very much for coming. Today, we're going to talk about just some things that owners can do to protect their interests in respect to their businesses, especially now, considering the uncertainty that has been brought to the Australian economy and globally due to COVID. Today, I'm going to talk about just some of the factors and the current economic position as we see it, some of the factors that owners should consider that are in the economy, and I guess the impact on some of the government's policies, which will impact businesses and business owners, especially heading into early next year. And I do want to also go over just how owners should structure further capital should their businesses require funding, and to protect their own interests, and basically for the money that they put into the business, but also allowing them to control the business, in the event which hopefully doesn't occur, but can that the business starts to experience some financial distress and may head in an insolvent situation. Move on to the next slide, please. So, firstly, the hire industry is pretty diverse in the type of businesses that are covered. We've tried to prepare this presentation so that all business owners, depending on the type of business that you have within the hire industry, the content is relevant. But some of the content will be, I guess, towards the higher end, where I will try to talk to the mum and dad type businesses as well, because it is relevant when putting funding into a business. So what we see, generally with your hire industry, that your hire fleets are funded by third-party financiers, mainly with finance leases as the type of facility, and also with the contribution of owners. And because of that, the way that owners put their money into the business, should the business require funding, is important to protect their interest, and to make sure that in the event of an insolvency situation, that one, the owners are able to have and control the process, but also are able to extract as much funds as they can, depending on the situation. So let's move on to the next slide. The current economic position at the moment, it's a bit confusing to contemplate. I mean, on the one hand, you have the ASX and stock markets around the world posting record figures, and significant growth since the start of the pandemic. Got many banks and other parties predicting that the economy will rebound in 2021, including increases in house prices. Where on the other hand, the ABS has confirmed that the Australian economy is in recession. There's significant government funding that has been put in to assist all businesses within Australia, but especially those businesses, in hospitality, tourism, retail, and the hire industry that have been significantly affected by the impacts of COVID. And we're also seeing a lot of the state and federal governments pushing forward major infrastructure projects to stimulate the economy, to try to give it a kickstart into 2021, so that there isn't a significant downturn. What we are seeing is whilst there is the COVID SME loan structure that's been put in place that for lending to businesses, the banks are being conservative around their funding in many cases. And I guess whilst it's an unknown, and it's an unknown whether or not there'll be more government stimulus in the new year, it is very difficult to determine, and there may be a significant number of business insolvencies once JobKeeper and the JobMaker programs get ratcheted down in the first quarter of 2021. So it's hard to tell, are we headed for a soft landing or not? And one of the things that we've advised our clients the whole way through the COVID-19 process since last February, March, is to really plan and prepare their businesses, for a worst case scenario, and that will put them in good stead if we have a soft landing, to be able to make decisions and possibly expand and grow, hopefully, if the economic situation is better than we expect in 2021. Move on to the next slide. So, some of the factors to consider when we're looking at the economy is that, international travel isn't expected to return to normal in 2021, and probably not for a few years after that, being realistic. The recent behaviour of China as just an extra concern in respect of a number of industries is an area of concern. And whilst that may not directly impact members of the hire industry, in many cases it will directly impact major customers that you may have, which may cause unexpected issues, with your working capital and other parts of your business. We're continuing to see, although it's good to see that Australia is moving in the right direction around, COVID cases, that restrictions around people movement and, the limits of congregations in restaurants, weddings, etc., seem to be being lifted, which is positive. However, as we saw in Victoria, it doesn't take much or take very long for the situation to worsen and for restrictions to be put in place, which can dramatically impact your business. And as I mentioned before, the JobKeeper program and also the JobMaker program will end in March 2021 at this stage. So, whilst we've seen a lot of businesses that are pretty happy and are travelling quite well because of those government stimulus policies, really understanding how your business will go forward, I guess, from April 2021 is important for you to manage your cash flow and your working capital throughout the year. We've also seen positives around the landlord code of conduct has been extended in most states. There are differing dates depending in what state you're in as to what the length of the extension is, but for the most part, most states have extended that policy up until at least 31 December 2020. And then there's also other things to consider around the SME loan structure. A lot of the repayments will start to fall due around October, November, and those payments can't be delayed anymore. And whilst the ATO have taken a pretty positive approach around helping businesses throughout this process, at some point, and depending on how in arrears a lot of businesses are in respect of the taxation obligations, we may see that the ATO become a little bit more aggressive in enforcement, but that remains to be seen. On to the next slide, please. So one of the significant trading risks just that we foresee, which, the policy around the temporary increases to the threshold, which creditors, can enforce debts, be it for a company, the statutory demand, it went from $2,000 to $20,000. And in respect of bankruptcy, a claim against an individual went from $5,000 to $20,000. But probably the biggest part of all of that is the time periods where you'd have to respond to a SAT demand or a bankruptcy notice if you're the insolvent debtor, went from 21 days to 6 months. So that policy has been extended to 31 December 2020. And because of those policies, which was effectively just to right the ship for the Australian economy and to give business owners some time to breathe throughout this COVID period, has resulted in a significant decrease in insolvencies generally throughout the economy, which would indicate to us that there'll be a catch up in 2021 when these policies are finished, and there'll be probably significant amounts of insolvencies, especially in the corporate space. Part of that, we would expect that, you know, if there is some financial distress or you do have some issues with bad debts because of customers going into an insolvency situation, that your credit practices, you know, should be refined and considered and looked at, and really look at credit terms being provided and being monitored probably on an ongoing basis if you do have customers that are slowly falling behind. It may be, and it's not necessarily a pleasant experience, that when your customers do go into liquidation or a voluntary administration process, that if you've received payments, if they're being, you know, on your general lump sum payments to pay off the debt, or a large payment after you've initiated enforcement proceedings, that a liquidator could demand a preference payment from you as a company. And, you know, from our advice is generally, whilst one of the key indicators of that is that you knew that your customer was nearing insolvency or becoming insolvent, it's always best to take the cash or get the payment and deal with what comes at a later date. Just moving on to the next slide. So I'm going to look at now just how you protect your owner's interest when you're providing further shareholder funding. Let's move on to the next slide, please. And the main reasons for doing that is, one, asset protection. So protecting the funding investment that you're making into the business. Two, in an insolvency situation, enabling you to have control over or access to the assets that were given in respect of the funding you provided. Have a seat at the table so you can control events. In an insolvency situation, if you have security over the assets, that generally gives you a greater say than your general unsecured creditors in an insolvency situation. And also considering internal restructuring, which when you would need to restructure your business for whatever reason, if you have a corporate group and you have one arm of the corporate group that isn't doing so well, having security over the assets of the group allows you to be able to move and transfer assets between entities, which if you don't have that security, you can get yourself in a bit of trouble as a director for breaches of your duties, being accused of asset stripping and prejudicing creditors, apologies. Mainly because when people look or do insolvencies, they do look at each individual entity and they don't look at it as a group. So that if you're moving around assets or etc. Between entities, that can prejudice creditors of each particular entity. On to the next slide, please. So we're looking at how you structure and how putting security over any debt that goes into the business, and it may be some type of hybrid agreement where the debt becomes equity. Gives you a bit of flexibility with how you fund the business. There's also some tax benefits of doing that, converting to equity at certain points if the business rebounds and does do well. And also provides just some rigor around your governance requirements. I'm not sure if this applies to anyone at this webinar, but there's also some tax planning benefits in respect of whether or not you have your head co, which is an overseas entity, or any shareholders which are overseas entities in respect of how they take their dividends or interest and the tax they have to pay. Next slide, please. So what are the fundamental requirements when lending money, and what do you need to do and consider? And it really does, this will depend on the size of your business. It may be appropriate that you'll engage a solicitor and your business advisor accountant at that time to discuss how you'd like to structure your investment into the business. Or we do have other options for those businesses, smaller SME businesses, where engaging a solicitor just isn't cost effective given the amount of money that you want to put into the business. You don't want to waste money on legal fees. Just moving on to the next slide, please. So, I mean, real consideration when you actually are lending money into the business is that when you're taking security, that you've actually got to put in a relatively amount of actual contribution into the business. So you can't create a secured loan where you lend the business $1, for example, and take security over all the assets. It isn't really considered to be appropriate consideration for obtaining that level of security. A lot of cases that won't actually be relevant given the existing security structure that the business has, but they are types of things that courts look at. And especially if you already have lent money into the business and you have security, if you want to lend more money into the business at a later date, you have to actually have active consideration putting more money in as opposed to just taking more security. So there is case law preventing the fact that lenders who have tried that in the past, where they've tried to take additional security, courts have knocked that back because it wasn't deemed appropriate and it adversely affected the other creditors of the business. Let's move on to the next slide. So what do you need to do? Well, the inception, you have to have a funding agreement when the money is actually provided. You also need to take security and be it through a lawyer, or we can suggest other online providers now that can assist with these documents, having appropriate PPSR registration in respect of the money that's being lent. Will provide you with a valid security interest in respect of the money you've provided. And that has to be made in conjunction with real consideration. Otherwise, there's a risk, as we've previously detailed. Moving on to the next slide. These are the type of documents that will need to be put in place for you to take appropriate security in respect of any loans that are provided by the shareholders. Facility agreement. Facility agreements are just the key terms of your business. So your term, facility, your ability to take money from the loan, the pricings of the interest, any repayment terms, defaults, and for probably large businesses, covenants that are put in place in respect of the loan. The actual security agreement is property mortgages or your general security deed over your other assets of the business. And priority deeds, probably more larger in the town where there's multiple secured parties and just which party would have priority over the other in respect of the assets. Next slide, please. So who generally does this type of stuff? Your first and second ranking lenders will take security, significant equity holders, and high net worth individuals and family offices, including their hedge funds as well, and private equity who are making equity investments into businesses where they also like to have some of the facilities as loans. I'll just move on to the case studies. Next slide, please. So we've recently advised a couple of clients, and probably an example of when it's done correctly, and sometimes that comes with actually structuring business upfront, and when it isn't, and some of the impacts that have occurred following an insolvency event, which can happen. So I had a family-owned business that had invested in a multi-divisional business, fairly large business, which also included the land and buildings which the business was located on in multiple locations. Unfortunately, shortly following the investment, a few years later, that the business was unfortunately put into voluntary administration, and the insolvency resulted in substantial risk to the real estate assets within the group. And also there was issues with funding being provided and transfers of assets and loans between the different entities in the group, which were made on an unsecured basis, and they ranked behind the secured lenders, the employees, and some of the other creditors. The outcome, basically, the real estate was protected. However, it required the shareholder to put in almost $40 million to fund a deed accompanying arrangement in order to enable that protection, which, if set up correctly at the beginning, likely wouldn't have occurred. So that's just the situation that had happened at that point. Probably in a better situation where the structuring was correct and the way that the lending was made was correct. Private equity owned a contracting business where they acquired and they provided $5 million of working capital funding. They were the second ranking creditor behind just a normal bank who had priority. They had a rapid expansion of the business, but due to a number of factors with the management of the key contract, things didn't go so well. And as a result, because of insolvency and because they'd structured the way they put the money into the business correctly, they got a significantly larger return when the business was sold in the VA process than they would have if the loan was unsecured. So in conclusion, structuring your investment and taking advice around how you put money into the business and making sure you take security if it's warranted, which in many cases it is, can really protect you down the track, especially if your business experiences a little bit of financial distress. I'll now pass you over to Nick Guest to further discuss some other just protect owners.
Thank you, Matthew. Now Matthew's described how we can protect our investments into our business via security arrangements. I'm going to talk about our opportunities to further grow our investment and protect our investment in our businesses by ensuring that we are operating to an optimal level. As Matthew has suggested, we've been through some turbulent times, and we recommend that everyone takes an approach to assess their current situation and their current business. The first step being to review the current financial projections for the business. Where are they situated? What's likely to come through the future? Trying to look forward 12 to 24 months is incredibly important. And we always encourage, no matter what scenario, that you have a clear understanding of your future. The step 2 is to establish and stress test our funding structures to understand, do we have enough finance in place? Is it going to meet our needs? Is that appropriate? And then the step 3 is, this is the sense check, where we assess what's the value of our contributed equity into our business over a period of time. And this is really a sense check of if the wheels was to stop turning and we needed to recover our funding from our business today, what would we get back from our business? Once you've got that information, we move on to step 4, where we start assessing our future directions and our options to move the business forward. So we'll talk through that in a bit more detail. On the next slide, as Matthew spoke about it, and we won't linger on this, but we really have in 2020 faced unprecedented challenges for businesses. And realistically, they're going to continue to be challenges for a number of sectors of the economy into 2021. Very positive news in terms of national travel freeing up. Victoria's done a fantastic job in suppressing their COVID numbers there, and hopefully that will lead to a greater opening up and returning to some level of normality for some sectors of our tourism and our hospitality in particular. Government's funding into infrastructure and committed spendings are going to see, we predict, some real strong activity in some sectors, where we do believe that other sectors, such as some of the aged care and the sort of bricks and mortar retail, will struggle for a while. So how do we take advantage, or how do we put our businesses into the best position to take advantage of these opportunities? And this is where we navigate a path. And it's really essential that we do take the time out of our business to understand this. We say get the house in order, ensure that we have access to good quality financial reporting at all times. This really does support good decision making, and it doesn't need to be complex. It could be a matter of just making sure that you are in the habit of recording all your revenue transactions, your creditors, chasing up your debtors, doing the basics so that you do have, on a timely manner, a good understanding of where your financial position is. Encouraging everyone to continue to access any support that may be available, whether that be through federal government incentives such as JobKeeper, which does have a few months to run for some sectors. There is instant asset write-off reliefs from a tax advantage that may tax advantage some asset purchases. Really do consider if that's relevant to your business. Obviously, these assets do need to be funded and paid for, but that may provide a benefit to your organisation. There are grants and so forth as well. With that in hand, we really do recommend just continuing to engage with all your stakeholders, talking with your staff internally, your advisors, whether they be your accountants and lawyers, your banks, your customers, and your suppliers. Keep your ears open and keep the channels of communication open, because, as Matthew mentioned, we do see a number of businesses come into trouble because of counterparty risk, whether that could be financial distress of somebody in their supply chain or one of their key customers, which can have then adverse impacts on your business. So it's worth considering your exposures and whether there's an opportunity to mitigate risk in that manner. Then we move on and say, okay, let's consider what market we are operating in. Do we have particular risks in our market or opportunities to take advantage of those? And so then we say, once we've considered these, we develop a strategic plan. Now, it really is essential, I think, for future success and for growing the value of our investments into our businesses, to have a plan and come back to that plan on a regular basis to both monitor how we are progressing against it, but also adjust it and take proactive steps so that we can increase the value of our business, which is obviously then protecting our interests in that business. It is okay to be uncertain. We don't have all the answers, and there are so many challenges for all businesses out there. But what we can do is, engage and speak with others, and with that, we can circle back and update our plan as needed. So strategic plans aren't fixed, and so they do address uncertainty, and we can amend often our short-term actions to help achieve our longer-term strategic plans. most importantly, don't panic or don't put your head in the sand. If you are facing some challenges, 99% of the time, you're going to get a better outcome if you speak up early, seek support from both internally and externally, and try to constructively work to the best outcome for yourselves and all stakeholders to help protect the value of your interest in your business. Designing for future success. Even in challenging times, it is really important that organisations do consider what their future goals might be. And often for business owners, the future success may be a continued growth of their business, obviously funding their continued lifestyle costs and living via returns of profit and salaries from their business. But often for a business or business owner, one of the most valuable assets that they own or control is actually their business. So ensuring that that business value is also continuing to grow and monitoring that regularly to potentially provide a windfall or value at a point in time that the owner chooses to exit their business. To do this, we again come back to that strategic plan. Potentially, if it's been a while since a strategic plan was developed, you can complete a diagnostic review of your business, taking into consideration key aspects from both the financial functions internally, considering where your business sits and where your key customers and what their needs are, and potentially identifying opportunities to move the business into different areas or further take advantage of emerging or changing environments. It does come back to having good internal systems and processes, again, that can deliver quality information in a timely manner. We would always urge making sure that we get quality information over quantity. And if we can be able to produce that and be able to review that in a succinct manner, that really does help good decision making. And again, it does not need to be complex. Most sort of basic accounting packages and business management packages these days are able to produce good quality reporting in a timely manner. It's about reviewing it, understanding it, and making informed decisions. Next one. One area that we are seeing increased risk across all organisations is in relation to cybersecurity. We really have seen an increase in these risks over the 2020. HLB internationally have completed a survey of organisations and gained some insights into some of the increasing risks that businesses are facing. There's a report available, which we'll share with you in the link to today's notes. If you haven't, even if you're operating a fairly what you consider a simple business, there are some quite simple steps that you can take to further protect your information and your customers' information, and reduce your risk of potential cyber security hacks, and because they can be quite devastating to all organisations. So it is something to be important to be aware of and respond to. That largely wraps up our core of our presentation for today. I think we have received some questions in the Q&A, and if there are any others, please feel free to post.
Thanks very much, Nicholas. I might run through some of the questions that we see, if that's okay. Start off with one example. If we have a small business and I've loaned money into my business to fund operations over a number of years, is there a practical way for me to protect these funds, and how much would that cost?
I can probably answer that one. It does depend. If you've loaned the money and you haven't set up, and you don't have a loan agreement and you haven't registered a security interest, the money that's previously gone in, it's pretty hard to take security retrospectively. That being said, depending on the situation, you can work through withdrawing money and then putting it back in, subject to a security arrangement that's put in place. For your SME businesses, there is online platforms now where you can put in the details of the shareholders and how the money will be loaned, and they will provide the pro forma documents for you, and that's at a significantly lower cost than having to engage a solicitor to prepare all the documents and to make sure that the security interest is registered. But probably for your larger businesses, and the significant amounts of money being put into the business, it's probably wise to engage a solicitor to advise you in respect of making sure that you have a valid security interest and that all your loan documents are robust and legally binding.
Thanks, Matthew. Another question here. We often hear that small businesses are very much focused on the operations and perhaps not so much strategic. What would your advice be if people are looking really to put a good strategic plan in place, and where would they start?
I'm happy to take that one. Look, my constant advice is to start somewhere, and it's not uncommon that owners and operators of small to medium businesses are hands-on in the day-to-day operations of their business. What we suggest you do is start quite simply. Again, there's a huge amount of literature that can be quite easily available, accessed online, or speaking to an advisor. Start by writing down why you initially got into your business, and potentially where you want to be in 12 or 18 or months, or in 5 years' time. And then with that, starting to break down what you need to do within your business to help you achieve those goals. Because what we find for quite a number of small business operators is that the objectives and goals of the individuals, being the owners of the business, aren't too dissimilar from those of the business. So trying to capture those and then at the high level, and then it's quite practical to step out some sort of specific and actionable goals for the business. So it can feel overwhelming. That's why we suggest just starting with I guess the specific goals of the business owner or operator, and then turning those through to business goals.
Thanks, Nicholas. One more question here. How would I actually know if the money and all the time I've invested in my business is increasing in value? I know a lot of the small business owners put in very long hours and obviously putting in some of their own money, and touched on that. Is there a good way to try and attribute some value to that?
Yes, there is, and I think that is a very important exercise to run through. Even if there's no intention from a business owner to be exiting their business in the near term, I think it is reassuring and sometimes motivating for a business owner to be able to see that see and feel that their contributions to their business are benefiting them. Some ways of measuring this can be an exercise similar to what was set up in our slides. We're capturing a value as of today, and one of the easiest ways to do that, as we set out, is to consider it, even if a wind-up value. If we were to stop, music would stop, and we needed to recover all our debtors and funds and repay all our liabilities, what would be left with today? And that's really the base level of what a value might be. Now, in most cases, we'd hope there's some goodwill and some value in the business that's been generated over periods of time. Projecting forwards and then having a methodology to measure the value on a periodic basis, whether that be on an annual basis after the annual sort of financial reports and the tax returns are prepared, is probably a decent time to be doing this. You can consider what income has been drawn out of the business, and I guess what value the business owners are being able to pull out of the business on an annual basis. That's another okay measure. But also having a understanding of the valuation methodologies that would apply to businesses within the sector and the industry, and using that as some KPIs and benchmarks to progressively review. And it's quite an interesting exercise to do on a periodic basis, whether that be annually, because applying your most recent financial data into a similar model can demonstrate a path to growing the value of your business and potentially helping achieve and progress towards the goals of the business owner. So that's something we often tie into a strategic plan, is setting some goals and KPIs around those valuation metrics.
Nicholas, we haven't got any other questions that have been posted, so unless any come up very quickly, we'll probably wrap up for today. Is there any sort of final comments before I wrap up that you or Matthew would like to make to today's audience?
Maybe a general one, James. I think that we are really facing some quite unprecedented times, and which are seeing some both positive and challenging aspects. I think we're hearing more and more about people considering 2021, hopefully pivoting back towards closer business as usual, which is going to mean different things for different industry sectors. And we are seeing more and more interest in and from business owners who have effectively felt like they've weathered the storm of 2020 and really keen to put in place some strategies and take advantage of hopefully a more positive economic climate in 2021. So I think it's always a good time to be reflective coming towards the end of a calendar year, but I think in this 2020 it's even more so.
Yeah, I think it's definitely been a time to ask some serious questions and refocus and set that direction for where you want to go. And hopefully we're all on the same page that 2021 is going to be a lot better than 2020 was. But I really appreciate your time today. So thank you, Nicholas and Matthew from HLB Mann Judd. As always, these services that are benefits of membership of the HRIA. So if you've got questions that come up after this webinar on other topics, please feel free to reach out to our partners. We've got a page specifically in the member area of the HRIA website with contact details for HLB Mann Judd, or we can put you in direct contact through the national office here. Look, that's it for today's webinar. Thank you very much for your time. Thank you to our presenters. And a reminder that the next webinar in our series will be on Wednesday, the 18th of November, and that's a technology webinar on business continuity. Thank you very much. Goodbye.
Thanks, everybody.